Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes.
Okay, today Mena and I would like to talk about business restructuring. Now, we've spoken a lot in this podcast about different business structures and when you would use those business structures. In fact, if you go back to season 1, episode 1, that's exactly the podcast that we kicked off talking about in terms of talking about comparing trusts to companies to personal name, all those sorts of situations. Unfortunately, though, not everyone gets it right all the time. And in fact, we probably see more terrible structures than great ones. That would definitely be the case. So much so, sometimes when we see a great, very well-structured business, we're kind of surprised. So we thought today we'll talk about, okay, if you've got a structure that's not really working for you, how do you go about fixing that structure?
I think it comes down to asking yourself, what were you trying to achieve by getting into business? Now, a lot of people try to get into business for things such as work-life balance. So it's important to structure your business in that case in somewhat of a unitized structure. So it allows equity ownership in your business so that you can take a step back, give equity to one of your staff or another competitor, or it could be a supplier or a complete third party, so that you can take a step back, still enjoy some profits and enjoy a bit more of a healthier retirement. There's other cases where you might want to attract capital or float. So again, you need a unitized structure that allows that. And sometimes it's a build and sell concept. You know that you can build a particular business and sell it quick, or, build a lot of goodwill, and, you want to just maximize your after-tax capital gains proceeds. So how can we structure it so that we ensure that we can get access to things such as the small business CGT concessions or even the 50% CGT discount? So it's really important to ask yourself, what am I trying to achieve first by getting into business, and then basing your structuring decision based on that.
The next thing with regards to a restructure is business risk. And business risk can change over time immediately. So it's quite possible that a particular structure suited you when you started the business, but either the industry's changed or your business has changed and that structure is no longer serving you from a risk management perspective. So, the first thing to think about is really, what are your business risks? What are your industry business risks? And of course, we can set ourselves up in a company environment, and that will protect our capital. Whatever capital's at risk that's being put into the business, that's all. Your personal assets are at least protected. But of course, there are things that directors can be held liable for. Occupational health and safety breach, substantial breach. Potentially they can pursue you personally for that. More and more, the ATO is holding directors accountable, and rightly so, for taxation liabilities and any employee-based liabilities like super and PAYG instalments and so forth. That is holding them personally liable, and trading while insolvent as well. So think about who are the directors of your business, and quite often, sometimes we see both spouses as directors of a trading entity. And it doesn't need to be that way. We would normally have one spouse as the director, and let's keep one spouse not at risk, and then potentially have personal assets in that non-director spouse's name. The other thing you need to think about is protecting assets within the business. Of course, you could be sued by a creditor, which could be a customer or a supplier or someone like that. But you also an action could be taken against you as an employer, so from your employees. So quite often it makes sense to separate the employment entity from an entity that holds assets. Now, whether that's intellectual property, whether that's, other sort of hard assets, property, plant, and equipment. Sometimes it's better to have those in two different entities to kind of quarantine to as much as possible the liabilities, whether it's from a customer or a staff member. The other thing to think about also is retained earnings. Again, if I've got a company that has a lot of retained earnings, then it's rather attractive for me to sue that company. If I want to agitate to try and get some money from something, versus a company that has paid out all its retained earnings and has very little assets to speak of course, you're less of a target. And so that's something else we see quite often as well. Companies with a lot of retained earnings, sometimes several millions of dollars. Well, of course, all that money's at risk because, it's still the company's money. It's still retained earnings that haven't been paid out as dividends. And so if I go and sue you, I can force you to sort of try and stump up that cash. Quite often the cash isn't in the company, of course, but that's okay. It would have been taken out through a director's loan or something like that. Again, I can then force you to repay that loan, in a way, draw on your personal assets to end up paying what is a company debt.
There's various other considerations outside of tax that you should consider when taking up structures, and that could be things such as stamp duty as an example. In some states in Australia, when you transact a business, the goodwill component can be subject to stamp duty. Now, this isn't all states, so only some states. So an incoming purchaser, if they're not purchasing, for example, the shares of your business, but rather the goodwill, and stamp duty is incurred, they might discount the consideration for your business by that outgoing. So it's really important to set up your business by knowing what you're trying to achieve in the long term and what jurisdictions you actually lie in. Another consideration could be land tax. If you're holding any real property within your entity, is a trust structure, for example, the right structure given that trusts incur a surcharge land tax? Another consideration could be around FBT and assets. Is there any personal use to the assets? Should they be in a particular structure? Small business CGT concessions and a 50% CGT discount, as another example, is not available in all structures. So it's really important to know all these considerations before setting up a particular company or a trust.
Of course, you're going to think about a couple of questions as a result of listening to this podcast. Firstly, how do you know if you've got a structure that is broken or it needs to be restructured and fixed? And that's difficult because you don't know what you don't know. I guess probably the most common hallmark that we see is where clients have been with the same accountant for many, many years. It could be like 10, 20 years or something like that. And the common story is that when we first met that accountant, we were dealing with one particular person and they were fantastic. And over the years, the firm's either merged with others or been acquired. That person no longer works at the firm and, they've got to know the other accountants in the business, but, it's changed a lot over that time. The problem is that it's difficult for a firm to pick up past mistakes. If a certain structure's been recommended 5 years ago, there's not a lot of accountants, at least we don't see it very often, where they'll turn around and go, well, you know what, it was wrong. It shouldn't have been set up like that 5 years ago. Let's go and fix it. And so that could be one of the sort of things that you want to think about, the hallmark. So what do you do about that? Well, as you don't know what you don't know, so probably best to go and get a second opinion. And if anyone walks into our office and wants a second opinion, you know what? We're not trying to invent work. We're already, thankfully and gratefully, busy enough. So, of course, we want new clients, but we're not going to invent work. So if we met a client and they say, well, here's my situation and it's all perfect, we would say, your accountant's doing a great job, well done. So I think a second opinion is probably the only way you're going to work out whether it's right or wrong. And then the next question you're probably thinking about is, what is a restructure involved? And we'd love to talk about that, but it's so varied. It's difficult. It's difficult to tell you because it really depends on the existing structure, the type of business, the numbers involved, their personal situation. There's so much into it. It can be expensive, but at the end of the day, you want obviously the benefits to more than offset the cost. And so sometimes a restructure isn't possible because it's too cost prohibitive, but it's important to investigate something like that anyway. Okay, so hopefully that gives you a bit of an insight into, what to look out for and sort of how to go about it. And until next week, bye for now.